You're looking for infinite banking examples? Well, in this video, I'm going to show you examples that we've used for our own clients. So hang in there. So you're interested in infinite banking, but you're wondering what does a good infinite banking policy look like? What's a good example? What are the bad examples? That's exactly what I'm going to show you in this video today. And by the way, hang in because I'm going to throw in an extra little bonus example for you too. All right, so those of you looking at infinite banking, you're probably wondering what it is, right? This is obviously not using a bank. This is actually using whole life insurance policies to then use as your own bank, quote unquote, meaning that you've got this source of funds because it's not just a death benefit when you have whole life. It also has this living benefit, this cash value, this tax-free savings account that you can then use for whatever you want. It could be used for emergencies, it could be used for college funding, it could be used for retirement, it could be used to buy assets and investments and all kinds of things. It's really a nice tax-free savings account that produces a higher return than you'll get with the bank anyways. Now, many people will ask, they'll say, well, how do I know if I have a good infinite banking policy? What are some examples of that? And often we talk about this conceptually on this channel all the time, but so often people say, yeah, but can you show me what that looks like? What does that look like for me? Now, I don't know you individually. Obviously, you're watching this video. You know me better than I know you. However, I want to give you some examples of some of you that did reach out and said, here's what some other people sent us. Is this good? Is this bad? What is it? Well, that's what I want to dig into right now. All right, so you'll see in this first example right here. Now, this guy came to us, he said, all right, this is what some other insurance agent sent me. This is with Guardian Insurance Company, which is actually a company we also use. And he said, look at this one. Is this set up well? Is it not? Could you guys do better? And so we took a look at it. Now, Guardian is actually one of the top 3 companies we like, right? But they're not the best. And so we said, all right, well, it depends on how it's designed. If they designed it really well, it could be competitive, but it may not be. Now, this one, it's really interesting, and this is one thing I hate. And you'll notice this as you see this on the screen here. The annual premium, that's the third column from the left. That annual premium, I hate it when insurance agents show you all these random different numbers. And by the way, this was the simplest of the numbers this guy said. This guy showed numbers going all over the place. And my experience has been is that for most people, probably like yourself, you like things to be simple and easy to remember. You don't have to think, wait, what am I going to be paying this next year? What do I have to pay this year versus that year because the numbers are bouncing all over the place? You want to have something that's a little bit more steady. And so this guy sent him this, and this is, I'm not kidding, this is the easiest example he sent, just so I can make it easier for you guys. But you can see he's throwing in almost $125,000 in the first year. Then it's right around a little over $100,000. I don't know why the numbers keep varying from year to year. It's really ridiculous. And then finally, it drops down to like $47,500. And we said, tell you what, this is not bad, right? Because for example, you put in $125,000 that first year, you see there on the far second one from the right, it says $92,143. That's the cash that's actually in there. That means that roughly about $30,000, almost $30,000, or actually just over $30,000 are going to insurance costs to pay it. Just so you know, whole life insurance is the most expensive in the first year or two. About year 3 or 4, those fees lighten up. It's front-loaded costs, and then it gets cheaper over time. Versus term gets more expensive over time. It's the opposite. So obviously it's more expensive. So you can see there's roughly about almost $33,000 coming out in that first year. Even the second year, he put in $100,000. There's still at least another $4,000 coming out of the premium he's putting in. So he's now paid in at this point over $225,000, but he has $165,000 at this point. That means he's paid about $60,000 in costs up to this point. Okay, so now you can see that after 10 years, right, you've paid in well over $1 million. This is probably actually bordering roughly about $1,030,000 and change, actually probably a little bit more than that. And you'll see that you have just over, again, $1 million. So you finally spent all these 10 years putting this money in. Even after 5 years, you put in about $530,000 and you've got $462,000. You still haven't even broke even. This is the big critique that everybody says about infinite banking. They'll say, wait a minute, even after 5 years, I've paid into this sucker and still I've got nothing. And so let's show you this next one over here is what we sent him. We said, you know what? Let's just make this $100,000 a year. We won't even put in the extra $25,000 in the first year, which means we're actually putting in less money, which means we should have less money, right? Wrong. Check this out. So you see here, you put in $100,000, he's got $81,000. Yeah, there's less, but remember, there's now 80% of it going in, only about $18,500 in costs. Now that next year, what's interesting is that he put in another $100,000. Remember the other one, they put in about $226,000 or so by that point, and only had $160,000 in there, $165,000. Ours already has $171,000. So he's put in about $26,000 less, yet he has $6,000 more already. Year 5, guess what? He's put in $500,000, he's got over $500,000. Remember, he only had 460 some odd thousand after putting in 530. So we even put in like $30,000 less by this point, but he's got about $40,000 more. And even after 10 years, he's now got 1.2 million versus just over $1 million bucks. Again, putting in well over $35,000 less. That's the key. And we even show them, like we even stop it after age 65, stop paying in, and the other policy, that Guardian policy, never catches up to our policy. Why? Because we lower the insurance costs. We make them cheaper. Because if you lower the insurance costs, you actually allow the cash inside to grow faster. This is the key difference. This is why we call it max ROI infinite banking. That's the biggest key difference. Now let me show you some other examples. Okay, now here's another one where this person already has a policy. Because many times people will say, wait a minute, I bought one several years ago. Is this one okay? So you'll see with this person, this is through a company called Ameritas, another company we're also brokered through, but rarely ever use. And this one's already 10 years into the policy. So you can see that this one starts at year 11 or age 57. Many people also ask, they'll say, does this even work if I'm in my 50s or 60s? Yes, this still works. Even if you're well into your 60s, late 60s, about 70 years old, still works great. Now they've been putting in for 10 years and they're pretty disappointed because as you can see, like they're stuffing in money, but at this point they really only had roughly, you'll see here, they put in for 11 years, almost 17,000 a year. That's like almost 200 grand, yet they only have 75,000 in cash. That means most of this is going to insurance costs, which by the way, insurance costs pay the agent more money. This is what we try to minimize, right? So now normally if something's this old, typically we won't say to do anything with it. But once I run an apples to apples comparison, just to kind of double check for them, I was shocked when I found this. Now you'll see in mine, like it starts at year 1. So really their year 12 is like my year 1. There's 11-year difference, okay? Now you'll see here it's about $83,000 there in year 1. That's why there's 92,000, 16,000 plus the 75 that transferred over. Now you've also got another 17,000 going in, year 2, 101. Now 5 years in, right? So 5 years in, this is at year 5 for this one. It shows $168,000, almost $169,000. Now what is it on the other one? Now remember the other one, we got to add 11 years, would be year 16. Look at this, going back to the other one, that year 16, you've got 142,000. So already within the first few years, we're kicking the crap out of it. And this is again a policy that has already paid the bulk of its fees up front, yet because there's still expensive costs on the back end, it just keeps taking and taking away. And this is the thing that was really worrying them. They're saying, wait, we're putting all this money in, when's it even gonna break even? Even at year 10, you'll see it goes from 189 to 205. That means it hasn't even gone up, really it's barely going up about the same amount, a little less than the same amount they're putting in each year. There's still more coming out in insurance costs. Where ours, by that second year, it's already paying for itself. It's already making more than what you're putting in. That's why it caught up so quickly. So needless to say, for this guy, this was a no-brainer once he got to see it. Now, at first he was a little confused because he thought, well, how could it be so good? Once again, it always comes back to the insurance cost, not the company per se, although the company can help, but it's how much can you pull different levers to lower the costs while allowing that money to go in and still stay tax-free. All right, so here's a third example. Now, this guy sent me his State Farm policy, right? Because like a good neighbor, State Farm is there. And so he sends me this policy and he says, what do you think of this one? Now you'll see this here. It's a little bit hard to read. But I highlighted in yellow some of the key things. First and foremost, this guy's putting in 10,000 a year. It doesn't really say that clearly, but that's what he's doing. Year 1, zero cash value in that first year. Year 2, he pays another 10,000, 2,800. This does mean he puts in he's putting in $20,000, only has $2,800 in it at this point. Not too atypical for a traditional whole life policy. In fact, most traditional whole life, you might be 0 at year 2 as well. So this was a little bit better. Now look at this. We're going now 15 years out and it's got $130,000. That means he's paid in $150,000 to only have about $130,000. Now contrast with ours, right? Put in $10,000 a year. Year 1, it's not 0, it's $7,700 in this example. By the way, he would actually get better numbers now because that same company just lowered some of their insurance costs. But this is good. I don't want to overpromise anything, right? So $7,700 he's got after putting in $10,000, way better than 0. So now the second year, remember that other one only had $2,800? This one's got over $16,000. Even by year 5, he's got about the same as what he paid into it by this point. And remember, 15 years, he only had $130,000 in the other one. Here he's got $207,000. What does that mean? That means he's been overpaying, or would be overpaying if he did a State Farm policy, by $77,000 for nothing. And that's putting in $10,000 a year. That's out of just the $150,000, he'd be overpaying $77,000 more than cost than he should be. This thing should be producing more money for him. And this is not just with whole life policies, right? Because again, even when people teach about infinite banking, they have different levers they can pull to make the insurance cheaper so that you make more money. The whole concept of infinite banking is so that you have more money to use in your banking system. But what happens is most of the time, infinite bankers, because they got to get themselves paid, because that's the only way they make money. They're not investors or business owners like we are, where we make money off of our investments. This is just gravy, right? They're actually trying to make a life out of this. They're trying to pay for their family's needs. They're trying to pay for Christmas and everything else. They want to be able to pay for all those birthdays coming up for their kids. That's what they're doing. So they might give you a little bit of a benefit, but they don't give you the full benefit that you could be getting with the lowest cost possible. This is why, again, we call ours max ROI, max return on your investment or return on your money, max ROI, infinite banking. We want to make sure you get the biggest bang for your buck. Now, some people will say, well, Chris, what about universal life? We're starting to hear indexed universal life coming around, and they're even trying to use it with infinite banking, which, by the way, Nelson Nash, shout out to Nelson Nash Institute, who creates the infinite banking concept. You know, Nelson Nash, when he talked about infinite banking, never intended it to be used for universal life for a few key reasons. One, universal life insurance actually gets more expensive over time. It's like term that invests the difference. It gets more expensive as the years go on, where whole life gets cheaper. Second, the index is usually based on the stock market, like the S&P 500. What if the market goes down? The last 15 years has been incredible with the stock market. But at what point do we start to see that market come back into balance where you don't get the same returns that they're projecting on their numbers? In my experience, and I used to sell universal life insurance, including index universal life, I will tell you this. In almost every scenario, it was always overpromise, underdeliver. The numbers that we sent those clients in the past, and even to this day I'm seeing, are higher than what the reality actually became. So you're getting worse numbers than what the reality was. So as a result, I stopped using index universal life for that very reason. Plus, there's just no certainty with it, right? Now, here's the other problem too. They also have what's called surrender charges. So this example, this is one of my clients I've had for many, many years, dear friend of mine. And this guy was just telling him, hey, I'll run some numbers for you. Well, my client didn't realize he wasn't just running numbers, he was actually putting in an application for him. Because sometimes insurance agents will use this little tactic where they'll say, hey, listen, you know what, let's put in an application, let's put all this in there, see what the insurance company comes back for your health rating, and then I can send you numbers. So this guy never had numbers up front. This is one thing we do differently. We send you the numbers even before we ever apply to say, here's what it could look like. We don't mind if people shop us around because we know we're gonna kick the crap out of them, and it makes insurance agents mad. In fact, some of them will even try to lie and cheat to say, here, I got them to beat their numbers, but then all of a sudden they don't tell you, oh, it's gonna trigger taxes for you. But hey, we beat their numbers finally, right? So they'll do little tactics to try to confuse you. But that's one thing he did. He's like, he put in the application and everything, and then next thing you know, he's getting drafted. All right, so you see here, he's putting in almost $11,000, $10,980. So about $11,000, we're gonna round up here. Notice go over to the fourth column from the right called cash surrender value. This is the money you actually have access to in universal life. This is different than that net account value. See, there's cash value in there, right? But they lock it up. They put what's called surrender fees. So if you ever try to cancel the policy, if you ever want to access that cash, they won't let you. They lock it up. Now they'll gradually back off those fees as time goes on. You'll see eventually that net account value and the cash surrender match at year 15. It means that finally the fees drop off. This is a tactic that Universal Life uses and companies will use so that you don't cancel your policy too quickly. You'll stay in it for the long haul. Nothing like that ever exists with whole life. There are no surrender fees or charges. Whatever you see is what you get. Simple, which is what I love. Now, notice this cash surrender value is 0 in year 1, 0 in year 2. And even if you go to the far right column, by the way, I'll use that one. That's the one that shows like almost a 6% return if you get 6%. So 0, 1, 0, 2. He's putting in $11,000 a year, $22,000, 0 that he can access. Finally, year 3, he's got a whopping $144 after paying in almost 33 grand. 144, guys. Finally, by year 4, you start to see it ease up a little bit. Now he's got 11,500. But notice, 10 years, he's put in almost 110 grand. He's only got 91,000. Now, flip over to ours over here. You'll notice here, did the same thing. Year 1, $8,600, not 0. Year 2, not 0, 18,000, right? Now, when you get to year 10, he put in, again, that almost 110,000, he's got almost 130,000. Remember, in the other one only showed him having 102,000 bucks, but here we got 129,000. That means we've saved him $27,000 in those costs, and he has more access to cash early on. So the whole way, he's got way more money. Needless to say, he was very ticked off at this financial advisor, this insurance planner, right? Very ticked off at him and was canceling the policy. He's like, this is a piece of crap. Why did I get it in the first place? I don't know why. Let's do something different. Let's do something better. And that's exactly it, guys. Like when you're looking at infinite banking examples, it's hard to know what's good and what's bad when you just get these numbers. The best thing you can do is to shop around. Get multiple offers, get multiple stuff. Now, if somebody says, I don't like being shopped around, good, because that just revealed the real intentions. They're saying, don't, if you're gonna shop me around, I'm out of here. It's because they know they'll lose. I love it when people wanna shop us around because they come back later saying, you're right, yours is the best. And even this person tried to do it, but they cheated. Or they'll even say, hey, Chris, they sent me these numbers. These actually beat your numbers. Is it possible? And I'll say, no, they did it differently. They actually have you putting in more money than what I had you putting in. You just didn't know it. So you gotta be careful of that stuff. But that's why it's good to have multiple offers. Here's my challenge to you on this video. If you're looking at infinite banking examples for yourself and you wanna know what it looks like, reach out to us. We have the link down below. Find out and book a call to say, what is it we can do? What's an example look like in my life? No commitment, no hassle. You're not sending in any checks at all. We just want to show you what's actually possible in your example and if it's worth it. If it's not, if somebody actually has something better, we'll tell you. I'll tell you in almost every situation when it's really close, it's usually at best a tie. But 99% of the time, we destroy anything else you're going to get out there. So anyways, we'd love to be able to serve you. Let us throw our hat in the ring. Reach out to us right here, right now.